You may be a new Shopify seller or your store is growing and you have probably heard that you need to be tracking inventory and cost of goods sold on your QuickBooks, accounting, or bookkeeping. And you're wondering, what the heck is inventory and cost of goods sold? Hi, I'm Veronica Wasik, and welcome to the Mavency channel, where we help Shopify sellers just like you to set up, organize, and streamline their bookkeeping and integrations. In this video, I'm going to explain to you the fundamentals of inventory and cost of goods sold and what you need to know in order to track these balances for bookkeeping and accounting purposes. Let's start by defining what is inventory and COGS, or cost of goods sold, for bookkeeping and accounting purposes. Inventory refers to the goods and products that are ready to sell, as well as raw materials and component parts that are used to produce goods and products. Cost of goods sold, also known as COGS, refers to the expenses that are directly related to the production of goods and products that have been sold. Cost of goods sold may also include, as we said, the cost of inventory sold, payment processing fees, shipping costs, inventory adjustments, and other types of expenses. There's a direct relationship between inventory and cost of goods sold. If inventory goes down, then cost of goods sold generally goes up. Or the opposite is true. If inventory generally goes up, then cost of goods sold will go down. There's a lot involved in doing proper inventory accounting. You need to be tracking vendor suppliers and deposits, inventory in transit, inventory on hand, unpaid inventory, inventory sold, and cost of goods sold. Obviously, this is in a perfect situation, and as we'll discuss later, you'll see that there's perfection, and then there's what you can actually do as an e-commerce seller. Let's go over the flow of inventory and how it affects balances for financial purposes. We'll start with a purchase order. A purchase order does not have any effect on your accounting and bookkeeping. Usually, you place a purchase order to purchase inventory, and you generally then pay your vendor in advance for the inventory that you have ordered. In that case, when you pay that vendor advance, you're going to have to increase the balance in vendor advances in your bookkeeping. And then later you'll receive your inventory. And when that happens, then you'll need to increase inventory. So the balances that were in vendor advances will now move over to inventory and will increase inventory. When you sell inventory, then you will have to decrease your inventory. And then you will also have to reflect cost of goods sold. And so when we decrease inventory, then we will be increasing cost of goods sold, as I said before. Let's go over a simple example. We purchased 10 units of inventory at $50 each. That gives us $500. And then we sold inventory. We sold 3 units at $75 each, and it gave us an income of $225. For inventory purposes, we'll need to track the initial quantity purchased. That was 10. Cost, $50. And that gives us an inventory amount of $500 when we receive the inventory. And as I said before, when you receive inventory, that increases the inventory balance. But then inventory was sold. So we sold 3 units, again, tracking the cost of $50. So we're decreasing the inventory by $150. And then that leaves us a balance of 7 units at $50 and leaving a balance in inventory of $350. Now, when we look at cost of goods sold, remember that we sold 3 units, that the cost for those units was $150. So then in cost of goods sold, we will also reflect an expense of $150. As I mentioned before, we have an ideal, we have perfection, and then we have what can actually happen. When we look at the ideal, and if money was no object, this is what you would be doing. And in fact, large corporations track inventory this way. They're dealing with inventory accounting formulas, inventory valuation, whether it's LIFO, FIFO, average cost, tracking vendor advances, tracking inventory in transit, unpaid inventory inventory and cost of goods sold adjustments are related to possibly physical inventory and obsolete inventory. And on top of that, then you would have to layer inventory operations, tracking SKUs, landed cost, purchase orders, vendor advances, item receipts, supplier invoices. You'd be dealing with fulfillment, reorder points, and much more. That is the ideal. Again, if you had an unlimited budget, unlimited hours, if you had a large corporation, this is what you would be doing. But the reality is that sellers, especially those e-commerce sellers who are just starting out, don't have the time and resources and ability to deal in perfect inventory tracking. And so the reality, it really has to do with what can you really do in real life based on the time, resources, and the size of your business. So you need to find the right fit based on the stage in your business, your desired goals, and your ability. For the stage in your business, think about whether are you a new seller? Do you have a growing business? Do you have a mature business? What is your desired goal? Do you want to stay out of trouble with tax authorities? Or do you want to have visibility into your profits? And then think about your ability, your time. Do you have people who can put time into tracking inventory? Do you have the tools and software applications that you need? What about processes and systems? Are you systematized yet? Do you have a way to really manage things in a very efficient manner? And do you have the money to invest into putting in all of these resources and tools to be able to track inventory? So think about this. For inventory bookkeeping purposes, whether you're starting or growing, you need to think about what would make sense for you and your business. So if you're just starting out, you may consider adjusting inventory only once a year. This is the most basic way of tracking inventory. It's really a good fit for smaller sellers. When you have less time and resources, you may be using spreadsheets, maybe using Shopify inventory to track your inventory. And really your main goal is to be compliant with tax rules. But if you have a growing and profitable business, then you may want to consider tracking your inventory for accounting purposes on a monthly basis. In this case, you will likely need to be using an inventory management app. You'll be able to have more insights into your profits, but you would need to have the time, resources, and money available to invest in the systems and processes and tools that you need. And again, you have to have processes, systems, organization, likely have a small team that can help you to track everything that flows through inventory. And ultimately, it's about balance. What do you need to spend your time on? Do you need to spend it on increasing your revenues, maybe setting up your store, promoting your store, increasing your sales, promoting and growing your brand, versus accuracy? Accuracy is great. We as accountants love accurate numbers and accurate financials, but you have to think about what makes sense for you based on where you are in your business, as I mentioned before. Accuracy will help with compliance with tax rules, having accurate inventory and cost of goods sold amounts on a monthly basis, and will give you ultimately some visibility into your profits as a whole. Again, you have to think about what makes sense for you and where you are in your business. So trajectory for you, if you're starting out and thinking about, okay, now I have to track this inventory and cost of goods sold, and, I don't know where to start. Number one, start with your landed cost. You need to figure out what your landed costs are for all of your inventory products. Then move into using a spreadsheet to track your inventory or Shopify inventory. Keep in mind, Shopify inventory is not an inventory management system, but it will help you to track your inventory. Ultimately, your goal is to move toward using an inventory management software in order to really streamline your operations, as well as then have the reporting that you would need to track your inventory and cost of goods sold for accounting purposes. All right, so the main takeaways are that inventory accounting and bookkeeping can be complex, but you need to choose what makes sense for you and where you are in your business and the resources that you have available in order to be able to track inventory. And make sure that you determine what makes sense for you. Do you need to spend more time on your revenues and growing your business? Or can you afford to invest in tracking inventory at a much detailed level in order to get a lot more visibility into your profits? For resources on Shopify bookkeeping and financial management, check out our free Shopify bookkeeping blueprint. I've linked that for you in the description. Are you ready to work with a trusted and reliable team of Shopify bookkeeping pros who understand Shopify and inventory accounting? Then check the description below to learn more about Mavency and to see if whether we'd be a good fit for working together. Thanks for joining me today. Remember to like, subscribe, and hit that notification bell to stay updated with all things e-commerce bookkeeping. Till next time, happy selling!